Cool. Well, thank you everyone for coming. My name is Marko, and I'll be talking about a very interesting topic, which is fundraising fuck-ups. I think, well, this is definitely a first kind of keynote, first workshop for me during the pandemic. So hopefully it will go smooth. I definitely want to thank Urban and the team for inviting me. I've known Urban and the Slovenian team for a number of years now, and yeah, super happy to actually make it to the conference. So just, I think in short about me, so I'm currently the COO of Memgraph. I used to work before for Netokracija. I used to help the Zagreb incubator of entrepreneurship before. I had my company called Time Prep, and then I spent the last 5 years with Techstars in London, helping and basically working on the six actually programs with 50 or 60 companies before I transitioned to Memgraph. And I think before we dive into the actual kind of fundraising and the actual details of the process and everything, so these are the companies that I have worked with. These are the companies in my portfolio, and my fundraising background basically comes from back in 2015, raising the Techstars London Fund, and then working with all of the companies that have an asterisk here that have raised capital later. And so during the program, during the Techstars program, and after as alumni. And these companies raised capital from their pre-seed rounds to seed rounds to certain Series A's at this point as well. So, for example, LiveBit just raised their Series A. We've had Kenko that raised their proper seed, kind of 3 million, and a bunch of other ones. So there's a lot of experience. I think there's a lot of things that I have seen, that I have observed, that I have helped during the fundraising, I guess, processes and the fundraising challenges that the companies had as they were fundraising. At the moment, accidentally as well. So I'm with Memgraph. Memgraph is one of the Techstars London companies as well, and we are fundraising now as well. So I'll make sure to share some of my kind of experiences, some of my observations regarding fundraising at this point in this kind of fun times of the coronavirus environment as well. So if we dive in, all the entrepreneurs, all the founders, all the CEOs have this kind of magic plan that looks like rainbows, that looks like clear skies, that looks like everything is, it's going to be smooth. It's going to be a smooth ride. The reality is it's most often way different, right? So it's completely different. There's some clear skies here and there, but it's a path of bombs. It's a path of kind of rain. It's a path of rocks, and it's just hard. And I think the reason why I say this is to have this in mind before you actually start to fundraise, to prepare yourself mentally for it, to prepare your team mentally for it as well. Because even though you can expect to close, and you can have the expectation to get the money in the bank in 2-3 months, and get the thing done, that thing can prolong for a while, and that fundraising can last for 6, 9, even 12 months, and maybe even never happens. So I think the reality is to just have that expectation in mind whilst going in it. I think one of the things that I tell our companies, that I tell the companies that we have worked with, that I have worked with, is to have certain things in place before actually starting to fundraise. And those things are your network. Those things are people that are around you, people that have helped you out in your journey, people that are close to you, that you have a really good relationship, tell them that fundraising is going to kick off. Tell them what your plan is. Tell them what you are trying to achieve, because they will be the ones telling everyone else. They will be the ones spreading the word. They will be the ones. They will be your ambassadors out there in getting those lead gen investors and getting those first conversations going, and it will just help you out on the journey. I think the second prerequisite is, even though everyone thinks these are investors, they're actually lawyers. So making sure you have the right lawyers, making sure you have lawyers in the first place, is something that can be super helpful on the journey. Because even though lawyers are seen and are basically thought of as, something unnecessary, something that, the startup is basically spending cash on, having a good lawyer by your side can help a lot in the negotiation, can help a lot with the, small text, helping a lot with the actual terms of the fundraise. They might also know a bunch of investors, so they can obviously kind of open doors. But I think having someone by your side who will be basically the bad guy in the negotiation, who will help you out when things get tough, with actual advice, with proper advice, can be really good. So kind of have those people by your side before you actually kick off. So the whole presentation is basically, I'm going to talk about certain assumptions and certain thoughts that founders and CEOs have on their journey from zero to actually having the money in the bank. And the whole presentation is basically thought of as, basically thought that CEOs primarily have before going in, and certain kind of fuck ups, if I can say it like that come out of it on the back of it. So I think the first thought that any CEO has, and it's pretty much attributed to the media and to the TechCrunch and all these other websites that celebrate all the fundraisers that happen, is I should definitely raise, right? And the reality is, well, sure, you can raise, you can go ahead and actually ask people for capital in exchange for a piece of your company, if you want to grow fast, if you want to actually take your company and everyone in it on the ride where you believe you will be able to grow fast, that you need that capital to build more features for your product, that you need more people in to actually get employed and actually work, then probably your monthly burn, probably your monthly revenue will not be able to sustain that desire and that wish to actually grow that fast. So therefore, you should raise. However, there's a bunch of companies that have bootstrapped for a while, and that bootstrap in general, and that basically don't raise. Probably the most famous or the most well-known one is Basecamp, right? So they didn't go out, they didn't give a half of their company or a third or a quarter of their company to someone else. They're still their own bosses, basically, and they're doing fine. But that's the route that they chose, and it's a route for some. It's not a route for everyone. But should you definitely raise? I think you should definitely think hard about whether or not you want to go down that route, because there's plus and minuses on both sides. So the next thing that I hear quite often from the CEOs and from founders is that they can start at any time and anyhow. And even though I think in practice, yes, you can, and you're going to have the conversations, and you're going to have, you're going to tell people and do the process and go through the process. I think timing is crucial. And timing is crucial for a number of reasons. I think it's the fundraising process. When you go into it, you want to make sure that the fundraising process lasts as little as possible, so as short as possible. And if you optimize for that, you want to make sure that on the other side, the people that you're talking to, the investors, are available, that they are basically available to take meetings, that they are basically available to make decisions. Because any day, any month that you lose on fundraising, you're burning cash and you're running out of cash. So one of the things that we have observed, one of the things that I think is quite important, is to actually count the months to your to the end of your runway, count the months that you plan on fundraising, and see if where those months come in, because especially in Europe, August and half of July, all the investors are on holiday. Everything's slowed down, if not stopped. December and January, everyone's on holiday again. And in December, so the investors are basically closing the deals of that year. They're not taking new deals. They're not taking new meetings. So therefore, if you start to fundraise in October and you start to have certain conversations in November, and then you start to have, or you would like to have, additional conversations in December, that's not really going to happen up until January. So you will basically lose a month and a half of your runway on December and January without actually having meetings, without progressing, because it's just the nature of things. So I think it's very important to know in advance where you are at, how do the months actually work, and to plan for that in advance. The second thing as well is you can't really, or you shouldn't, I don't think you should start fundraising without having a bunch of stuff in place. And it's a clear checklist. There's a clear checklist that investors will ask for, and having that in place instead of trying to figure those things out on the go is, I would say, really, really important. So the investors will ask for a bunch of stuff. So everyone's going to ask for, an investor deck. Everyone's going to ask for, some kind of a financial model. They'll want to see, what will you do with that capital that you're trying to raise. They want to see what will you spend cash on. They want to see, how, the previous revenue that you might have. But I think there's also going to be a bunch of documents that they will want to see that will explain actually what you're doing. And I have found, and we have found, that having an FAQ with a bunch of questions and answers about your business, both on the business side, both on the market side, both on the go to market. So how do you actually plan on getting there? Can be super helpful and can basically streamline the process. Because instead of jumping on calls and explaining stuff, you can basically share the FAQ with the investor, and they have a look, and everything's pretty much written in. So I think having those docs in place before actually kicking off the process is important, and it's going to help. So I would strongly advise having those docs before you actually kick things off. Because the downside is you have a conversation with an investor today, and tomorrow they come back and say, hey, I need this doc. Do you have this? I want to read more about it. And then you take a week of actually figuring things out and creating the document. At that point, you share it back. They come back with another request, with another ask for another document for a product roadmap, right? And if you don't have it, then you spend another week actually figuring that out and actually creating it. And it just slows the whole process down. Additionally, you can always reach out, or I would say when you prepare for the process, prepare to reach out to the investors in bulk. So because again, what you want to do is you want to minimize the time that the whole fundraising process will take place. And if you do it one by one, if you do it, if you're reaching out to investors over 3 weeks, then that's 2 weeks at least lost. And you could have, reached out in bulk, over a couple of days, and start to have those meetings done. So that's kind of, the second thing. Should, you can start anytime and anyhow. I don't think so. You need to be prepared. You need to have the plan in place. The third thought that the companies have is they will finish the raise in 6 weeks. I think, at the best of times, I think that's not realistic. I think you usually have what I've seen from our companies. It takes 3 to 6 months to get the cash in the bank from the first conversations. I have not the fastest kind of closing, the fastest that one of our companies has managed to close their round has been actually after the program. And so, for example, we had a company, they went through the program. The program was from July till October, and they signed the term sheet. And they signed the term sheet, and they had the cash in the bank in January 10th or something like that. However, so that will basically give them kind of 2 months after the program to actually close the round. But I think it's also worth saying that the bunch of investors that they've closed from, they have met during the program. So they did not really start from nothing. They had a lot of warm introductions, and they had a lot of warm conversations even before. So I think planning again, and it comes back to the calendar. Planning ahead and planning for those kind of 4 to 6 months in advance, I think definitely makes sense. Because on the flip side, what ends up happening is if you plan for 6 weeks and that you'll close in 6 weeks and you don't, then you're basically in real time seeing how your cash is running out, and you're going to need to do something about it, meaning you're probably going to need to either let some people go or get rid of the office or cut some other expenditure, maybe get some friends and family cash until you actually close the actual round. So have that in mind. The next one is all investors are equal. There are hundreds and hundreds of times that a founder reached out to me and asked, hey Marko, do you know any investors? I'm fundraising. Can you introduce me to any investors? And the answer to that is pretty simple. Yes, I know a bunch of investors, but it doesn't work like that. They're not all equal, and you should be talking to the investors that actually fit you well, rather than to everyone. Because what you want to do is you don't want to waste time. You don't want to waste your time on the conversations that will never lead to anything. And investors, again, they're not equal, right? Like they all have cash, hopefully all have cash, but they are different in a bunch of criteria, in a bunch of characteristics. So, for example, the first characteristic is stage. The investors that are investing in a pre-seed or seed stage will never invest in kind of Series A, Series B. And the other way around works as well. So if you ask me, do I know of any investor, and you're at a pre-seed stage, and I give you a Series A stage investor, that's a conversation that will not lead to anything. And it's just a waste of time, again, primarily on your side, and you've just wasted, at least a couple of days. So I think you need to make sure kind of to do your homework on it, to make sure who is actually a good fit. One of the other fits is check sizes. So who writes what kind of check size kind of investment. So from a couple of hundred to a couple of million, one size does not fit all again. To the sectors. So you want to make sure that the investors that you're talking to are in the sector that you are in. So for example, if you're a gaming company, it doesn't make sense for you to talk to an investor that only invests in biotech. They will not know how to run a game. They will not know they will know potentially how to play a game, but they will not have the connections. They will not have the experience of building a gaming company. They will not, it's just going to be a useless fit. There's also B2 what, so, is it B2C? Is it only B2B? Is it potentially some investors are investing in B2D developers. There's also marketplaces. So it just, I think, depends. Also, location. If you ask me about an investor that's not investing in, in Slovenia or in Central Europe, that only invests in, Northern Europe, again, it doesn't make sense for you to talk to them. Like, there's no way that they will change. I mean, there's some chance, but like, I think the majority of all these kind of characteristics are pretty much predetermined, and they will not change just because you're special. So I think assume you're not that special. You're what you're doing, and there's a clear fit. So there's a bunch of resources that you can use that can help you do your homework, which is AngelList and Crunchbase, and I think they can be super useful. One of the things as well is have a look at the portfolio companies that those investors have actually invested in. You can see from the portfolio what are the sectors. You can see kind of the stages. You can kind of dive deeper in there. But I think the crucial message here is don't assume that all investors are equal. They are not, and you don't want to waste your time primarily. You can waste, obviously, the investors' time. They'll care, or maybe not, but you definitely don't want to waste your time, because remember, your runway is running out with each day that it takes longer. So that's kind of equal investors. The next part is I'll work out the amount later. A bunch of CEOs, a bunch of founders get into the game and get into the process without actually knowing how much will they raise, how much are they asking, thinking that they'll work it out later. And I think the crucial thing here is to actually know yourself, to know what you are trying to do with the capital that you're trying to raise. So the way it pretty much works is you are going out, you're trying to fundraise, you're trying to get capital into the company, and that capital will allow you to hit certain milestones over the next 18, 24 months. And those milestones, can be from whatever they might be based on your stage. So those milestones can be, building a product, building an MVP. They can be, finding a product market fit, finding actually who the target market is. They can be, to increase, your sales, to increase kind of the growth. So it can be kind of growth capital that you're trying to get, that will literally kind of put spark the match and basically get you going. So I think making sure in advance, whether you're raising 400K, 300K, whether you're raising $1 million, maybe 2 million, or you're out there raising 10 million, 15 million, whatever that number is, you need to know what you're trying to raise. Because on one side, that's how you will kind of calculate what you're going to spend on, but then you will also get a bunch of questions from investors, because they will ask you, okay, so what do you plan on achieving with this? They will ask you, how will you spend the money? They will ask you, why 5 million? Why not 6? Why not 3? Can you do more with 8? What if I gave you 8 instead of 5? What can you do more? So being aware and being self-aware about that is pretty important. So that's the amount. Founders and CEOs also say, I'll just email them for the meeting. When they kick off the process, they say, I'll just, I found this email over here. I've scraped these emails from the VC's website, and I'll just email them. I'll say, hey, I'm John. I'm doing this thing. Let's have a meeting. The reality is, all the investors, or pretty much all of the investors, their inboxes are crazy. Cutting through the noise, cutting through the dozens and dozens and hundreds of emails that these guys get every day is super hard, and is I would say even impossible, because the reality is, it's a cold email. You're reaching out to a person you've never met. You're reaching out to a person you've never seen. they have not heard about you. They have no idea who are you. You're just one of the founders that reached out, and you're not special in any way. So I think the way to bypass that is you need a warm intro. So you need someone in your network, and remember, I've mentioned the network, and I've mentioned your kind of close people before. You want to make sure that there's a network around you who can actually open doors for you. You want to make sure that they can point you to the investor, that they can say, hey John investor, I have known Jack, the CEO here, for 10 years. We worked together. We've done some amazing things. I think you should really talk to this person because they're doing something amazing. And guess what? Guess what's going to happen? The investor will likely take that meeting, or it's going to be way likelier that the meeting will actually take place, instead of you reaching out coldly to the investors and then just being buried in a bunch of other cold emails that don't really go anywhere. Also, before actually having that email introduction, and before actually going through kind of the actual introduction, make sure that it's kind of double opted in. So double opt-in basically means that before that introduction to the investor happens, the investor has the ability to say no. Because what you don't want to happen is having the introductions just happen without the investor saying, hey, I'm not actually investing, or there's a portfolio clash in my portfolio and it's too competitive, we can't do anything with this. Again, you don't want to waste time by having the conversations and by having meetings that will not lead to anything. So it's always a good idea to ask your colleague who's going to make an intro to actually ask if that intro is okay. And then the investor will say, yes, it's perfectly fine. We're investing. We're in this. We're interested. That looks really good. Or they can also say, look, we've just run out of cash for our fund. We're fundraising for our fund. We don't have any cash. We have a clash. It doesn't look really that good. I don't want to waste time. Let's not do the introduction. So you always want to keep that optionality open. So just email. So don't just email, talk to people, get the intro, and then actually have the conversation on the back of that. Don't cold email. Also, one of the misconceptions that I know our founders made was thinking that they'll talk to 10 investors and then they'll be done. They will only need 10. One of them will say yes, and it's going to be the end of the fundraising, and it's all going to be good. They'll be on their way, and it's going to be perfect. The reality is that it takes way longer. It's fundraising is, and it took me a while to figure this out as well. So fundraising is a sales game. So fundraising is selling, basically. So, and having that said, is basically a game of numbers. So from the top of your funnel, you want to make sure that your pipeline is long, that you have, it's diverse, that you've received a bunch of introductions, that you reach out to a bunch of people, that there's a decent amount of people that you have in your pipeline. Because otherwise, thinking ahead that you'll talk to 10 people and then one of them will write you a term sheet, 2 of them will write you a term sheet, and then you'll close the round again in 6 weeks. I think it's not common, and you shouldn't count on that. So the process, or the analysis that I think CapTable.io or someone like that, there was an article before, kind of did show that on average there's 58 investors that were contacted. They had 40 meetings, and then on average, kind of the companies raised 1.3 million, and it took them 12.5 weeks to close, so 3 months from the first meeting. So I think that's fair, but I also think you always want to have that buffer of time and that buffer of people kind of in the pipeline, so that you can go back to them and you can still, if something goes wrong, and things do tend to go wrong, then you can have additional conversations. It is also very hard to track all these conversations. So you need some kind of a CRM. You need some kind of a system in place where you and your team can actually track all these conversations. And from my experience in the fundraisings that I have done, Streak for me worked best. So Streak is the Gmail's CRM. It's not Gmail CRM. It's basically an add-on to Gmail. Sorry about that. So it's an add-on to Gmail, which basically shows you, you have the phases, you have the names, you can have certain kind of sources and emails, and it basically gives you the ability in your team to have visibility and transparency across the process. So this is the actual screenshot of when Max and I raised the Techstars London Fund. So you can see that on the top of the screen we had 125 LPs, 125 targets, VC targets, well, actually high net worth targets that we were talking to. We had a bunch of stages. So we had the lead stage, we had meetings scheduled, we had pitched, soft committed. So actually after the pitch happened, certain people will say, yes, I'm definitely in, I want to invest X amount, and I'm soft committed. Hard committed are the ones that actually signed the docs and have actually are actually in. So certain people obviously bailed. We had a bunch of people that we needed to check on before closing. So they basically said, look, I will invest if certain conditions happen. I will invest if that company exits, and then I'll have some liquidity. I will invest if this friend of mine comes in. So you need to talk to him. And then we had a bunch of kind of closed and unresponsive ones as well. So I think if you look closer, it was, we tracked it, and I think you should track it quite in detail, because you always want to know how your pipeline looks like. Again, I'm coming back to the selling. It's very similar. So it's a sales process. You're talking to people, you're offering basically some part of your company for certain amount of cash with certain other provisions, and you're moving people through the phases, through the pipeline. Also, on top of that, one of the I think very important things to have in mind is to follow up. I think it is, and I'm coming back to the fact that VCs inboxes are incredibly flooded, and you want to make sure that you are following up. So this is an example. This is the most, well, I guess one of the most recent examples where so we as Memgraph we're fundraising, and we have, as you can see here, we've had the first conversation with an investor around February 10th. And then after February 10th, we have been basically following up every 3, 4, 5 days, asking, if there's news, asking if they need more information, if they need more documents, if they need, if they had a chance to discuss with someone else, etc., etc. So I think it is very important for you to follow up. And, you don't want to be, don't want to be an asshole by following up. You don't want to be aggressive. You don't want to be, unpleasant. But following up is a perfectly normal thing to do, because what you're basically trying to figure out is you want to get a decision, and even a no is a decision because it makes you go past that. It makes you go to other things sooner. So making sure to follow up and making sure to follow through as well is quite important. And I have seen a bunch of founders and a bunch of CEOs who are not doing that. So I think there's definitely space to get better at that. So that's kind of only 10 investors will do, and they won't. You need to have numbers in place. You need to have the process in place. You need to have just the numbers in place, I guess. Founders also say, I'm just going in for a chat, without actually, well, maybe not thinking about what they'll say, but without actually being prepared. And I think it's just a wasted opportunity. So I think whenever you're talking to an investor, whenever you're talking to another person in general and telling them about your company, but especially if you're talking to an investor, always take that opportunity as kind of a pitch opportunity. You're always trying to sell. You're always trying to, tell them what's going on with your company. You're always trying to tell them what's been good, what's been working, etc. So there's been a bunch of analysis done that basically show how the pitch decks kind of would need to work, and would need to, what they would need to show, from the company purpose, the problem, the solution that you're trying to have and build, to the market size, the business model, etc. So I think, even though you don't necessarily always need to have the deck ready when you're having that conversation, you need to have these topics in mind and these topics that you're gonna touch upon whilst talking to the investor. Because, on the other side, these are the themes, these are the questions that the investor is actually looking at, that they are trying to figure out, and they are trying to find out from you. So without, again, wasting time, make sure that you hit those points, hit those topics, as you have those conversations. So only a chat. One of the things that I hear that I heard and that I still hear actually from our companies is that the investor is definitely in. And this photo is basically a photo of having happy ears. So the conversation with the investor usually goes, you have the conversation, you tell them about what you're building, you tell them about how great your team is, you tell them about what's going on, you tell them about the prospects, the sales that's been happening, the plans for closing the rest of your pipeline. And they come back and they say, yes, this sounds really good. This is this is something that we're definitely interested in. This is in our space. We know the sector well. Sounds great. You seem like a really good CEO. You seem like your team is in place. That's definitely something that we're interested in. And you go away and you put in your CRM that they are definitely in, that they are soft committed, that they want to invest, that they will invest, and you go further, you go on. The reality is that they are not actually committed, that they have never expressed their commitment, that they have never said that they will invest. They only said that the thing that you're doing is interesting, that they would like to see more, that they really like what you're doing, but they have never said that they are committed. They have never said that they will invest. So the way to bypass that, the way to actually figure out whether or not they're in or out, is what you want. You want to get back, when you get back from your conversation, you need to follow up and you need to say, hey, based on what we've discussed, I understand that you would like to invest X amount for X amount in this round. That there are certain other conditions that you want us to fulfill, and can you please confirm that I understood correctly? And then if they come back and say yes, that's the understanding, that's what we have talked about, then that they are definitely in. Without that, you don't really know. Without actually talking about the investment, and without them actually kind of committing, you simply don't know. And assuming otherwise can be really, really bad, because your pipeline, you will assume that you have 5 million committed, where in reality you probably have 3 or 2.5, because you misunderstood, is simply not good. So I think don't assume that having an interest and hearing that something that you're doing is interesting means that the investor will definitely invest. They did not say that. Make sure you are on the same page. Make sure that there are no misunderstanding in that process. Another thing is companies say valuation is key, and I think valuation is not necessarily the key. So in advance, you need to start from yourself. You need to start from your company. You need to figure out how much do you need in order to hit certain milestones. And basically, what that means is, if you hit if you think that amount is the one that will help you achieve those milestones, then in the conversations with the investors, the valuation will come up at some point, right? And the general thing that happens is that the reality is you will give away 15 to 25% of your company. And if you know the amount of capital that you're raising, then pretty much you can do the math and get to your valuation. And I think it's always funny in a way that, investors, one of the key questions, or one of the, the crucial questions, first questions that investors ask is, oh, how much is the valuation? How much, you're raising 5 million. How much is the valuation? You're raising 1 million. What's the valuation? It's like, on one side, I don't know. I mean, in general, you give away 15 to 25% of your company. We can work out the numbers, but the reality is that the market will basically give the valuation. I don't really know the valuation. I don't know if it's going to be 15 or 25 or 20. I simply don't know. The valuation will be a function of the market. If the thing that I'm working on is so hot that 100 investors want to get in, then the valuation will be super high, and therefore the dilution will be super low. On the other side, if no one wants to get in and you're having the conversation, then valuation might be quite lower, and therefore the dilution might be quite higher. So it's a question of the market. It's not a question of the founder, and therefore the valuation is not the key. The valuation will be a function of the process and the function of what you're doing. And on the other side, it's not really on the founder to actually set the valuation. Again, the investor can make an offer with the valuation. And at the end of the day, it's their job to make the valuation. They're investors. They're not, it's their job. So I think having that in place, having the thoughts like that in place, and making sure, that you don't anchor yourself on the valuation, I think it's quite important. Because on the flip side, what can end up happening is, before thinking about this, you can say, oh, our valuation, while we're raising 2 on 15, 2 million on 15 post or 15 pre, whatever it might be, we'll just get those investors. If they don't agree with you, we'll just put them off, and it's just going to be a point where you're not really gonna go past. So I think that's one of the just things that founders think. I need to know my valuation. You don't. You need to know that you're going to give 15 to 25% of your round. That's kind of the standard. That's something that happens to pretty much everyone for the amount of money that you wanna raise, and the market will pretty much set that valuation then from there. Valuation. Anyone will do for a lead. I think that's something, obviously, the founder, the CEO wants to close the round as soon as possible. And then you're having all these conversations, and you'll take anyone. I think the reality is you need to be super diligent, and you need to be super aware that you will not be able to kind of break that marriage once the investor is in. It is impossible, almost impossible, to get that investor off of the cap table if they are behaving badly, if they don't respect you, if something goes wrong. You want to make sure that the lead that's gonna lead around, that's gonna invest, that you have a really good relationship with them, that you are on the same page, that potentially you even know this person from before, because they will be in there with you through the good and the bad times. They will be the ones that will help you. They will be the ones that will support you. And again, kind of with the plan, with the startup, it's not always easy. It's never easy, but there are bumps in the road, and you want to make sure that the investor is kind of on your side, that there's no kind of negativity, there's no, the investor is not an asshole, and kind of stuff like that. So make sure to do your diligence, make sure you know who that person is, because the flip side can be quite bad. The other thing is what CEOs and founders say, that fundraising, it's going to be easy and it won't get in the way of running a business. I think that can be super bad. That thinking can be super bad, because it will get in the way of you running the business. It will get in the way of you closing sales. It will get in the way of you actually building stuff, building features, building your product. It's going to be pretty much a full-time job for a number of months until you actually close it. And therefore, the CEO, who's going to be the one actually running the whole thing, at least pitching, their focus will be primarily on the fundraise. It will not be on hiring. It will not be on building features. It will not be on biz dev. It will be on fundraising and making sure the round is closed as soon as possible, so that they can actually go and run the business. So make sure kind of the team behind in the background is aware of that. Make sure that the responsibilities are divided. Make sure you know that, and they know that you as a CEO will not be as available as before, because it's just the nature of the beast. And then you hopefully raise your round, and it's kind of celebration time. But I think the reality is what actually ended up happening is you have just given away 15, 25, 20% of your company to someone else for a certain amount of money that will hopefully help you grow faster. So even though there's all these titles about celebration, and this company just closed a massive round, this company just closed a huge round, they've become a unicorn, all these things, it is the reality that you have given away X% of your company to someone else. So I think there's just something to be aware of. And then you basically get the cash in the bank, and you can actually go in and run and build a business that you wanted. However, not everyone succeeds, so you need to have some kind of a backup plan. You need to think ahead, and you need to be prepared for the case if things don't go according to plan. The raise, kind of the drop-off rates from seed to Series A to Series B are just they're unbelievable, right? So and this is quite outdated. So back in the day, kind of only 25% of the companies from seed raise their Series A, then half of the Series A's raise their Series B's. So what I'm just trying to say is, don't assume that you will be able to close the round. Don't assume that everything will go as you really wanted and as you planned. And then I think to end up, these are some of the suggestions, I guess, and advice, I guess, whilst talking to investors. Don't say that there's kind of no competition in what you're doing. There must be certain competition. Even indirect competition is still competition. So make sure you actually do your homework and research the market and the competitors. If you go in and talk about kind of tranche investments, and the investor suggests for you to actually get the tranche investment. Tranche investment is basically an investment that comes in two parts. So let's say you're fundraising and you want to raise $1 million, and the investor says, yes, I'll invest $1 million, but it will need to come, first 500 will come now, and then the second 500 will come in 6 months' time based on the certain KPIs that you hit. The reality is, and again from experience, that second tranche almost never comes, and it just and then the fun starts. So you have basically signed and you assume that you will have 1 million, that you will have a certain amount of time, and you count on that 500K to come in, and it doesn't. And what ends up happening is you need to lay off a bunch of people. So we had one of our companies, one of our portfolio companies, did this, raised a tranche investment, and from 30 people, the second tranche never came. From 30 people, 30 employees, he needed to basically let go 20 or something, and it's just heartbreaking. I think it's really, really hard. So make sure, I would advise not to take tranche investments and not to do tranche investments, but at least have that in mind before actually kind of signing anything. NDA, don't ask for NDAs, and on the other side as well, if the investors ask for NDAs, don't sign the NDAs. There's a bunch of ideas out there, and obviously the ideas are important, but the execution of those ideas is crucial. So kind of the NDA will not kind of stop that, and the investors will never sign them as well. So don't ask for them. It's a rookie mistake, I would say. AI and ML, everyone has some kind of artificial intelligence and machine learning. I think if you really do have that deep tech, then sure, talk about it. But if you don't, if you're basically, if you have a binary decision tree, and it's just some if and else and then kind of clauses in there, don't try to oversell yourself, because people will go into it and people will ask you, and you'll just look bad. Again, jargon, there's a bunch of big words. Don't use the big words. Try to be simple. Try to explain it as simple and as briefly as possible, because it's just, don't try to, again, complicate things. And the last thing is, don't lie. Even though the fundraising is hard, even though you might be sometimes desperate as well, I think it is a very closed community, and it's a very small community as well. Investors talk amongst themselves, and if you get caught lying and saying something that is not true, the word will spread, and you will definitely, A, you will be labeled, but then B, you won't raise your round, and it's not going to end well. So have that in mind. Obviously, you're selling, and obviously you're trying to present yourself in your best light, but don't lie. Don't say stuff that's not true. So I think that's pretty much it from my side. I'm happy to take any questions. This is my email. If you have if you want to potentially talk later, if you need help with fundraising, if I can help in any way, feel free to reach out. Happy to help. But yeah, I can take some questions now if there are any. So I think that's from me. I guess you can put them in the chat. Okay, well, there's no questions here. Well, session. Wait. No. Okay, so I see the question. Yeah. What's my background? I'm just at home, I guess. So that's my background. So the question is, how long should the round take? I think I think it comes down to who do you know. It comes down how fast can you move. It comes down to professional background. It comes down to do you have the docs ready? I think it can last from. It also depends on what you're doing. So if you're well known, if something that you're doing is super hot, then you can raise in a couple of weeks. But if you're not known, if you're new to this, then if you need to hustle your way in, if you need to network your way in, I think it's definitely, it can take definitely longer. So what's my background? What's my professional background? So I've studied on the educational side, I have both computer science and business degree from Zagreb. I'm originally from Croatia, and then basically I've worked for Netokracija for a bunch of years, helped with some biz dev, helped with some event organization. I've also helped Zagreb Entrepreneurship Incubator set up basically in Zagreb. So I was one of the first organizers, and then I've started my company, which was Time Prep, which was basically an iOS time management app for CFA candidates. And then I wanted to see what the VC world was like. So I spent the last 5 years in Techstars in London, basically running the program as a program director, and worked with 60 companies that got selected from probably 6,000 companies, met pretty much all the ecosystems in Europe, and then basically figured out that 5 years at Techstars has been a lot of time, and wanted to see now what the other side looks like. And joined Memgraph. Memgraph was one of our Techstars London companies, raised the seed round in 2016. The guys raised the seed round in 2016, and we're now fundraising. We're now raising our kind of seed extension round, and it's going well. So we've signed the term sheet a couple of weeks back, hopefully gonna close the whole thing soon. It was Streak CRM, so that's the Gmail add-on. I think it's quite it's super useful. So they have a trial period. They have a free product as well, I think, so you can play around with it, see how it works, and then you can have a go. I responded. I'm just going through the questions. What do I think about crowdfunding platforms? I think it depends. I think on one side, there's definitely, so we had a bunch of our companies fundraise through crowdfunding. I think if you are, a B2C company, a kind of a consumer company, it definitely makes sense potentially to do that, because you can find, the crowd, you can find the investors, the individuals that will understand what you're doing way better, and they might be personally really invested. They might really be interested in what you're doing. If you're, a B2B company, if you're a deep tech company, I think there's a fair chance that crowdfunding might be not for you, because simply the crowd will not really understand what you're working on and will not really be as interested in what you're working on as they would be for, for a banking product, for potentially a juice product, for something like that. So I think that's kind of something that you need to have in mind. I think it also depends on what crowdfunding platform you actually plan on raising, because certain have better outreach, certain don't. I also think there's from just the governance standpoint, I think there's a certain thing to have in mind. If you do fundraise through the crowdfunding platform, it tends to be, all of a sudden you might have 50, 1,000 random people to you on your cap table. So just from the governance perspective, I think that's something to have in mind. What would be your advice to non-funded businesses that already have some local presence, good P&L, but would really like to grow regionally, globally? Should they join the VC game or use other alternatives? I think, look, if you can fund yourself through non-dilutive instruments, like grants, like R&D tax credits, like kind of those things, then always take the cash that's not going to dilute you. I think if you're local, there's also a bunch of funds out there, especially kind of in Central Europe land, in Central Europe that kind of raised their capital from EIF, from various other sources. and that basically have a bunch of cash that they want to invest. I mean, even in Slovenia, there's Field Rouge Capital, there's South Central Ventures, there's other guys out there that have capital. So I think just hustle your way in, reach out and have a conversation. I think if you do look well if your P&L looks well, if you do have revenues, real revenues coming in, and if you're growing, then it's just going to be easier for you to have those conversations and to actually close the round. Cool. Any other questions? Is there any way possible to receive the presentation? Yeah. So I will definitely share it with the guys at Podim, and then hopefully they'll share more. And I think this is going to be recorded as well, so hopefully you'll see the video. Which side of the table do you find more fun? I don't know at this point. It's only been 6 months, 7 months, 8 months since I joined Memgraph. I think both sides have. I think both sides are really fun. Actually, I think it's. I mean, from my perspective now at Memgraph, it's been super interesting to see, to just see the VC side. So I've been, I guess, on the VC side, on the Techstars side, have done a bunch of selection of the companies for our programs, and pretty much know what I would ask, what I have asked the companies. What are the things that triggered me? What are the things that I was interested in? Those same questions are the questions that we are getting asked now. So yeah, I mean, it's fun. I think it's fun on both sides. I don't know yet. Hopefully we'll be successful with Memgraph. So hopefully that's going to be even better. But I think one of the things that I always try to do whilst in Techstars is to be super humble about the founders that we were talking to, because these guys, the founders, my CEO now, they're doing stuff that they believe in. They believe that they will be able to build the business. They will be able to do something, change the world, and they truly believe this. So I think you want to, as an investor, when you're talking to these companies, you want to make sure that your approach is humble, that you want to really understand what they're doing, that you want to get down and really understand, really get it, without being arrogant, without being without being bad about it, without discarding people just because you don't understand. So I think there's been learnings on both sides, and I think the learning curve at Memgraph now with 8 months, it's been unbelievable. It's just learning is through the roof, and it just shows, I think, to me, and it confirms you really need to get your hands dirty to learn and to grow. So yeah, it's been amazing so far. But yeah, I'll definitely know more as we continue, as we do more good things. Thank you. Cool. Well, I think if there's no more questions, I think that's pretty much it. I will stop the screen share. And yeah, so you've got my email. Feel free to reach out. Happy to help. And yeah, good luck to everyone on their fundraising journey.